One of the most common questions that I get asked is, how do you form a limited company? It's a good question, but it's not the best question to ask if you're just about to start up your own business. The question you should be asking is, should I form a limited company? Or is there a better way of doing things? Because the truth is, not every business is best suited to be a limited company. But how do you know? Well, in this film, I look at the advantages and disadvantages of setting up a limited company. And let's face it, sometimes it's too much hassle and you're better off operating as either a partnership or a sole trader. I'm going to give away a few insider secrets about how to decide whether you need to set up a limited company or not. And you'll be surprised. Even some very big and successful companies operate as a sole trader, and sometimes this really is the best thing to do. So keep watching and I'll help you to decide whether being a limited company is really best for you. So let's begin by taking a very quick look at the different forms of business structure in the United Kingdom. Well, really, you can divide all companies into two types, either unlimited liability or limited liability. And the ones that are unlimited are called unincorporated, and the ones that have limited liability are called incorporated. And there are four main types of business. There are others, but the four main types are sole trader and partnership in the unlimited liability section, and private limited companies and public limited companies in the limited liability section. And there's also a hybrid form of business called a limited liability partnership. And I'm not going to deal with that in this particular film because it is quite specialist and it only applies to a few companies. It's usually solicitors, chartered accountants, chartered surveyors, a few businesses like that, but there aren't that many. Most small businesses, and especially businesses that are just setting up, will set up as either a sole trader, a partnership, or a private limited company. So those are the three that I'm going to look at in this film. Now, obviously, there are advantages and disadvantages of each. So I'm going to quickly go through what the advantages and disadvantages are of all three types of business. And this will help you in deciding whether you should set up as a sole trader, a partnership, or a limited liability company. Well, the obvious advantage of being a sole trader is it's really easy to start up. It's simple. There's no kind of legal stuff you have to do with Companies House. You just call yourself a sole trader and away you go, start trading. It's really, really simple. Not many legal obligations to think about. There are a few which I'll tell you about later. Obviously low startup costs, you don't have to pay any fees to Companies House, there's no legal fees, so it is the cheapest form of business to set up. You don't have to share any of the profits with anyone, such as other partners or shareholders or investors. You keep all the profits for yourself. Now, a really big advantage, and this is something I'd urge you to think about, is the privacy. A sole trader doesn't have to register the business with Companies House, and this can be a massive advantage with certain types of company. So financial and other records are kept completely private, and this is not the case with incorporated businesses like limited liability companies and PLCs. And this could be the clincher for certain types of business. It is actually very useful to keep that privacy and not to let your competition and not to let other people know about your financial details, which sometimes it doesn't really matter. Sometimes transparency is a good thing, but I'll be totally honest with you, sometimes with certain types of business it is best to keep things private, especially from your competitors, and sometimes it's useful to keep things private from other businesses. Okay, the final main advantage is tax benefits, but this could cut either way. And to be absolutely honest, on this one, you do have to speak to an accountant if you're not sure what you're doing about tax. Now, tax laws in the United Kingdom allow owners to treat their company profits as part of their personal finances, which means if you're a sole trader, then you pay income tax on your personal finances. You're not actually paying corporation tax. That can sometimes be an advantage, but it can sometimes be a disadvantage. So it's important, if you're not sure, that you do consult a chartered accountant to get the best tax advice. As a general rule, if you're running a very small company and you're just paying the basic rate of income tax, then there could be some tax benefits from remaining a sole trader. If you're a top rate taxpayer, then things get a bit more complicated. But the main thing I'm getting across here is, if you're not sure, consult a chartered accountant, because it could actually work either way. Okay, well, let's look at the disadvantages. One of the main disadvantages is basically you have unlimited liability. If you're unincorporated, your liability is unlimited. And that means basically you can lose everything, because there's no division between the company and the owner of the company. So basically, if you ran up a lot of debts as a sole trader, then if somebody comes after you to pay your debts, they don't just go after the company money. They can come after your house, your car, your personal savings, absolutely anything. So you have to be really careful. If you're running the type of company that might have a lot of expenses, that might be paying a lot of money up front, then it might just be worth thinking about setting up a limited liability company in order to protect your own private personal assets. Often that's not the case, but you do have to bear in mind that if you do run up debts and if you can't pay them, then it is possible for the people you owe money to actually come after you personally. And that could mean anything. It could mean your personal bank account. It could mean your house. You could lose the shirt off your back. So sole traders, they have unlimited liability, and the owner of the company is liable for any debts. There's also some pressure in being a sole trader. You're holding all the responsibility yourself. The success or failure is completely in your hands. So potentially there could be a bit more pressure. Although obviously if you're running a limited company and you're on your own, then you're still going to have that same amount of pressure anyway, whether it's a sole trader or a limited liability company. Sometimes being a sole trader can be less attractive to clients, and I have to be totally honest with you in this film. That is probably the main reason that I decided to make my company a limited company, because I didn't really have to. But running a marketing agency, especially when you've got big public sector clients, it's just more attractive to clients being a limited company. It has more prestige than being a sole trader. Now, this is quite a specialist thing, and for most companies it might not really make much difference at all, but certainly for the type of work that I do, when you're running a corporate communications agency that does marketing and public relations and that type of thing, which is what I do, it just is a bit more attractive to clients if you set up as a limited company. You just have a bit more prestige. And the final difficulty, which might apply to you or it might not, and that is about investment. Sometimes sole traders can be seen as being slightly higher risk, and therefore it can just be a little bit more difficult to secure investment from banks or from outside investors. It's not always the case, so don't get too hung up on it, but sometimes it can just be a little bit more difficult to secure investment. To be absolutely honest with you, speaking with my own personal experience of nearly 4 decades of running companies and working in business, I think the main advantage, certainly for me, in setting up my limited company was just to have that prestige and to make it more attractive to big clients. But I think for most people, the thing you've got to think about is the unlimited liability. And to be absolutely honest with you, I don't think that makes too much difference unless you are going to be spending a lot of money, say, on raw materials, or you're going to be buying lots of stock, or you're going to be spending a lot of money up front. And it's times like that that having unlimited liability can potentially be a little bit difficult. If you're putting a lot of personal money into your business, then you do have to remember that if it fails, then it is going to cost you a lot of personal money. But that for me, I think would be the main thing to take into consideration. Okay, well, let's have a look at partnerships. Now, partnership is run pretty much like a sole trader. But the main difference is it does involve more than one person. It's a little bit like a sole trader from a legal point of view, but with several people running the company. It's very easy to set up a partnership. You don't have all the legal issues that you would have with a limited company. And it's also very easy to add new partners. Not quite so easy to add new shareholders to a limited company, but very easy to have new partners if new people want to come along, new investors, people who want to get involved in the company. As the business expands, it can be easier to get loans. Banks usually prefer to make loans to larger enterprises that aren't just dependent on single people. It just gives that extra element of confidence to the bank. If there's 2 or 3 people working as a partnership, if one of those people, for example, if somebody falls ill or if they just decide to leave the company, then it just gives a bank or an investor a bit more confidence that the business will continue with the other partners. Obviously very easy to set up, just like sole trader, low startup costs. In fact, not really any startup costs, although it is wise to sign a partnership agreement, which you can download one off the internet, or if you want to, you can pay a solicitor to help you set up a partnership and put together a partnership contract. But it is very, very easy to do and potentially doesn't really cost anything. There can be some tax benefits, again, similar to being a sole trader. Again, partners within a partnership are taxed as individuals, so they pay income tax, not corporation tax. And this can sometimes mean they pay less tax. But as I said previously, if you're not sure, consult a chartered accountant, because sometimes you can end up paying more tax. If you're a basic rate taxpayer, then you may have some advantage in being in a partnership. Not always the case. So if you're not sure, consult an accountant. Okay, let's just look at the disadvantages of partnerships. Well, as with sole traders, the main one is the unlimited liability. The partners risk losing all of their personal money and the belongings, so that could be your house, could be your car, if the business has financial difficulties. And the amount you lose will depend on the partnership agreement. With most partnerships, the partners have equal shares in the company. Well, it's not really shares, is the wrong word, but they have an equal share of the company, if you like. So, for example, it could be a husband and wife team, and they may divide it 50-50. That's what they'd usually do. If it's a couple of friends, or maybe 3 or 4 friends in a partnership, usually it's divided equally. So 4 friends would probably be 25% each. But that will be defined in the partnership agreement. This is the important bit. So, for example, if you are a 10% partner, then you could lose up to 10%, depending on how much money is owed. So if somebody you owe money to comes after you for your personal money, then in the same way that the profits are divided according to the partnership agreement, any liabilities are also divided that way as well. So bear that in mind. You do have unlimited liability, and that will depend on the percentage of the company that you own within the partnership agreement. Lack of continuity can sometimes be an issue if one of the partners dies, or if they just decide to leave the partnership and the other partner is left there thinking, well, what happens? From a legal point of view, the original partnership just automatically dissolves, even if the remaining partners want the business to continue. So if there's 2 partners in a company and one of the partners just says, well, that's it, I've had enough, then the partnership technically no longer exists. So, for example, a a team of husband and wife, or for that matter, husband and husband, wife and wife, whatever. If they get divorced, then partnership ends. And likewise, it could be two friends that fall out. And if you fall out with your friend and your friend is your business partner, then the partnership ends. And I suppose you could carry on, but you'd have to either find a new partner or you'd carry on as a sole trader. There could also be some difficulty in transferring ownership because partners can't sell out their share without the consent of the other partner. It's not like a limited company where there are shareholders and the shareholders can sell the shares. When it comes to a partnership, if a partner wants to sell out, then they have to have the consent of the other partners, and that can sometimes get quite messy. Sometimes see that in family companies where the family company aren't operated as a limited company, they're operated as a partnership, and that can sometimes get very messy if there is difficulties within the family. There could also be some personal difficulties. Sometimes I've found in my experience the success of a partnership can depend on having good working relationships and mutual trust. And again, this sometimes happens in family companies. If there is a bit of a breakdown in trust, or if the working relationships don't work too well, then the company can fail. And again, you sometimes get this in where it's married partners who are also running a company as partners. Any kind of breakdown in the relationship, any personal difficulties can actually have an effect on the company as a whole. Okay, so the third option, and this is the one where you really do have to put your thinking cap on and think seriously whether you want to go down this route. And that is setting up a private limited company. There is more work involved. There is a cost implication involved, but there can be massive advantages of being a private limited company. The main advantage from most people's point of view is the limited liability. It means that you don't have to worry about losing your house, losing your car, losing the shirt off your back, because if you do run up debts, then the company can just be closed down and all you'll owe is whatever you invested to begin with. So, for example, in the case of my company, I issued 100 shares at £1 each. So my maximum liability is £100. Now, my company is never going to run into any financial difficulties anyway. I'm very confident of that. So it wouldn't really apply to me. But it could apply to some people if they run into difficulties. Then having limited liability does give you protection. It means that you do keep the shirt on your back, you do keep your house, you do keep your car. So that could be a massive advantage. There can also be some tax advantages. But again, I would stress, as I've said twice already, see an accountant if you're not sure, because sometimes these tax advantages aren't quite as great as what you think. One of the advantages, and I'm speaking now as somebody who isn't qualified to give tax advice, so I stress that, but one of the advantages could be related to national insurance, because it is possible to pay yourself a very small salary, keep your tax bill down, keep your national insurance bill down, and instead you pay corporation tax, because a private limited company has to pay corporation tax, but the owner of the company can minimise their income tax bill and certainly can minimise their national insurance bill. But please, I know I'm repeating myself, please see an accountant if you're not sure, but there can be some really good tax advantages of setting up a private limited company. You have more professional status. I've already mentioned this already, but there is definitely more prestige in running a private limited company, which is the main reason that I made my company a limited company, because I was dealing with some really major public sector clients, and they do prefer to deal with a more prestigious limited company than just a sole trader. And it can also be useful for getting funding. Not always, but quite often banks do prefer to deal with limited companies and directors of companies rather than sole traders. Not always, but also you can get funding and investment from other shareholders. I mean, one of the ways that a lot of limited companies get more funding is simply by issuing new shares, and that is obviously a great way of getting investment into your company. The disadvantage is fairly obvious. Firstly, there is more work involved. You have to register with Companies House. This can be a bit complicated. Don't let it put you off though. I've made other films on YouTube, which I urge you to have a look at, which tell you about some of the legalities and the things you have to do. For example, submitting a confirmation statement and an annual accounts with Companies House. Now, this is a lot easier than you might think, and I do a really simple step-by-step guide on YouTube to how to do a confirmation statement and another film about annual accounts. So although I always advise people to talk to an accountant about corporation tax, if you're dealing with HMRC about paying your tax, when it comes to filing confirmation statement and accounts with Companies House, believe it or not, it's a lot easier than you might think. And if you don't think it's easy, then just have a look at some of the films that I've made on YouTube and you'll see how easy it is. One disadvantage, which is, for some people isn't a disadvantage, for others is a big disadvantage, and that is you've got to make all your financial information public. For example, your balance sheet. Again, I've made another film on YouTube about balance sheets and the information you have to make public at Companies House, which anybody can see. Anyone can just log on, go online, see your information, see your balance sheet. For some people it doesn't matter. For other people, you might not want to share all your financial information. It depends on you as a person, and it depends on your company and the type of company you're running. You can't set up a limited company if you are an undischarged bankrupt or a disqualified director. Now, I hope that doesn't apply to anybody watching this film, but if you do happen to be an undischarged bankrupt or a disqualified director, then you can't set up a limited company anyway. And finally, the owner can sometimes have less control over the company if it is a limited company. That's especially when the company gets bigger and if you have other shareholders and then you eventually appoint a board of directors. Now, I suspect that for most people watching this film, if you're just thinking of setting up a private limited company, it might only be you as the only shareholder anyway, or there might just be you and your partner. There might not be many shareholders anyway. But just as to bear in mind for the future, when your company does get bigger, you will have less control, and once you start taking on other shareholders, other investors, and eventually have a board of directors, then you can lose a bit of control over your company. At this point, I'm going to give you two very useful tips that you won't read about in books and many experts won't tell you about, but these could be very, very useful tips. The first thing, just because you set up a limited company doesn't necessarily mean that you have to trade as a limited company. Now, that might sound a bit weird, but it is possible if, for example, you want to protect a brand name. You could set up a limited company and make that company dormant at Companies House and then just trade as a sole trader. And I've actually done that myself in the past. I actually set up a limited company because I wanted to protect the name of the company. So I basically registered it as a limited company but made the company dormant and then just traded as a sole trader. And that does have some advantages. Obviously it has some disadvantages as well. But the one thing is, if you are going to do this, make sure that your customers are aware of what's going on so it doesn't look as if you're doing anything dodgy. Obviously, you still have to submit your confirmation statement every year to Companies House. So even if your company's dormant, you still have to submit once a year to Companies House, and you still have to submit dormant accounts. But then you can trade on your own outside of that company as a sole trader. And the only reason you'd want to do that is just to protect the name of the company, just to make sure that, for example, if you have quite a unique name or a clever name or just something that you want to make sure doesn't get copied, then just register the name of that company at Companies House, make the company dormant. You can still carry on trading, but then you've protected that company name. The second tip is in relation to how you actually trade with different sets of customers. Now, this might sound a bit complicated, but it's actually fairly simple and fairly straightforward, and it could possibly be very useful to you, depending on the nature of your customers, depending on the nature of your product. And that is, don't set up one company, set up two separate companies, one a sole trader or a partnership, and the other a limited company. Now, obviously, you have to be careful from a tax point of view if you're going to do that. If you're going to be running two separate companies in parallel, then obviously on one of them you're going to be paying income tax, and on the other you're going to be paying corporation tax. And obviously on the limited company you do still have to submit all your accounts and your confirmation statement as usual to Companies House. I think if you are going to do this, you do have to make sure that your customers are completely distinct. And I'll give you an example. I once came across somebody who ran a big iron and metal business, and they were basically producing things like industrial iron products, gates, that type of thing for industry. But they were also doing domestic stuff. So for example, if you wanted a garden gate making, a bespoke garden gate, that type of thing, or some railings just for your house. And the company owner had actually set up two companies. He was operating as a sole trader when he was doing the domestic work, like, you know, making a little iron gate for somebody's garden. But for his big industrial work, he was operating through the limited company. And this actually worked very well for him from a VAT point of view, because the big limited company that was dealing with really big commercial users, commercial clients, they were paying VAT, and obviously they were claiming their VAT back as well. So that was all going through the books in that way. But if he was just producing a small railing or a little garden gate for a domestic customer, he was doing it as a sole trader. And this is perfectly acceptable. I mean, obviously, as long as HMRC are aware of what you're doing, and you have to then submit your accounts as normal as a limited company, and then you do a self-assessment through HMRC for your sole trader company. But as long as you can distinguish the two sets of clients, the two sets of customers, then why not? Why not operate two companies? Why not have a sole trader company and a limited company? The only thing I would say about this is, if you're in doubt about taxation, do consult a chartered accountant first. I am not qualified to give you advice on taxation, and it does complicate things a bit because you're obviously paying two different sets of tax for two different companies, but it is perfectly acceptable. And if you are in that kind of position where you've got trade customers but also domestic customers, if you're doing B2B and also B2C, business to business, and also business to consumer, then there's no reason why you shouldn't set up two companies. One of them is a sole trader, and the other one is a company that is incorporated and deals with bigger customers. It's perfectly acceptable. Just make sure that you do consult a fully qualified accountant, and just make sure HMRC know what you're doing, and make sure you get your tax right. Well, I hope you found this film useful. The main point that I want to get across is that forming a limited company is not always the best thing for every business. Sometimes it's better to be a partnership or a sole trader, and of course sometimes it's best to be a limited company. And on occasion it could be quite a good thing to set up more than one company and then to operate with several different business structures. Thanks a lot for watching. As I said earlier, I'd really appreciate it if you could subscribe, like, share, all that kind of stuff. I upload my business success secrets every week here on YouTube. Until next time, I hope you're successful in whatever you do, and I'll see you again soon.